And I'm going to blow your mind here. I'm going to invert the charts, and you're going to see that the price action literally looks identical. Okay. 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 So this was our Zoom call from yesterday, just to kind of go on to now the current market conditions. We talked about how unless there was any type of major bullish catalyst, we weren't going to see any significant price movements to the upside. But what we were expecting was a pullback into these previous weekly lows, right? We went on the weekly time frame. We analyzed where the weekly lows were at. We gathered an area of interest for where price action could pull back into for market makers to better position themselves at discounts as more data comes out this week. And so our first area of interest for a pullback was the $2.74 trillion range, just to kind of show you guys where the markets are at today. We're still hovering above that area, slightly starting to see some profit taking before we get into later data fundamentals this week, which I firmly think the market's waiting for more direction. But we're holding above the $2.74 trillion mark. I believe we're slightly down on the day, roughly about $24 billion, so nothing significant. Our analysis from yesterday still holds weight, right? As long as the fundamental developments can continue to support risk assets and we can continue to see some slight profit taking on assets like the yen, extreme safe haven demand for gold, right? We can possibly see some more inflows back into risk and we can hold these previous higher low areas. We'll get into that when we do the analysis. So let's talk about the environment today. All right. This rising, I updated you guys with the data from the US front. I said to you all that the data shows some strength remains in the US economy. Both core durable goods orders and durable goods orders came in much stronger than expected. Core durable orders, which excluded volatile items like aircraft, rose 0.7% versus a forecast of 0.2%, showing solid business investment. Overall, durable goods orders rose 0.9% when the markets were expecting a negative 1.1% decline, suggesting demand for big ticket items remains healthy despite high interest rates. This points to continued resilience in manufacturing along with consumer and business spending. So I said to you all, I'm still seeing some mounting uncertainties on upcoming tariff announcements and geopolitical tensions. However, at least the data is not coming out, adding to recessionary fears for now. So we can look at this in a positive limelight, but at the same time, it's not really a big enough data release to be like, oh, okay, as a large institutional investor, I'm super confident in this one data release. And so I'm going to take aggressive buy positions. And we can kind of see that reflected today in price action. All right. So that's why I try to update you guys. I didn't sit here and say, oh my gosh, like we're going to freaking go to the moon today. None of that stuff. Just updating you guys that the data was relatively positive, showing signs of strength and resilience in the US economy, but that there's still mounting uncertainties in upcoming tariff announcements. And how did I gather those insights? Simply from just reading. So we can see it reflected in the data, right? Gold is trading higher with Trump threatening to slap tariffs on copper imports. This was just announced over the last 24 hours. And we know new tariff announcements create what? Uncertainty in the markets, or at least refrain investors with much more money than you and I from taking aggressive bullish bets as they kind of wait to see how this data is going to impact the markets. They don't want to just jump ahead of the curve. They want to see how the market digests it. So gold price is edging higher to around $3,027 per ounce at the time of writing on Wednesday and is turning this week's performance into green numbers. The precious metal is being bought together with other precious metals as copper pops to new all-time highs. Copper metal is in the eye of attention after the United States President Donald Trump mentioned on Tuesday, that was yesterday, like I said, that copper tariffs will be implemented in the coming weeks, which is far sooner than the market was anticipating. Remember, the market does not like uncertainty and random surprises in the market via announcements on the fundamental geopolitical or tariff side of things, right, tend to spark uncertainty. So this was a pop-up and a change of sentiment, right? Meanwhile, there's also a headline risk. I highlighted this because you can see the words in the fundamentals, right? Pay attention to key vocabulary. Headline risk on Ukraine, where a Black Sea ceasefire deal is on the table. Ukraine's President Vladimir Zelensky was quick to support the breakthrough and said his country was ready to adhere to it effectively immediately. The Kremlin was quick to issue additional demands that would need to be met. This is also something to be paying attention to, that would need to be met before a ceasefire deal in the Black Sea could become valid, right? So remember, I told you guys that just because we see these positive headlines, because this is, don't get me wrong, of positive headlines, it is not valid yet, right? So this one line sentence right here, the Kremlin was quick to issue additional demands that would need to be met before the ceasefire deal in the Black Sea could become valid, even though this is a positive fundamental. So a retail trader coming into this market today might be like, oh my gosh, ceasefire deal talks, great, long crypto. No, that's not how it works, because we can see reflected in price action today, crypto, give or take, did not have any significant bullish move yet. I mean, it's 10 a.m. here in Central Time, 11 a.m. So almost half the trading session is over. Couple more hours left, but so far, no significant bullish price action. So we're still seeing more demand for safe haven under current market conditions, which are slightly uncertain, right? Now, if this was more positive and more optimistic, like an announcement of a confirmed ceasefire came out, boom, that would be probably enough momentum right there, a confirmation to drive markets higher, because that would change the narrative, which is lingering right now. It's like, are we going to see a ceasefire, or are these mother truckers going to keep fighting each other, right? So we're like in between. But if it was more positive and they came out and said, yep, everything's confirmed, they shook on it, they spit on their hands, they shook on it, freaking no more blowing up each other. Yes, that would completely change the sentiment, most likely back to risk on more significantly than we've seen since the middle of March. All right. Let's see. So that's all I have for this report. Let's come over here and see if I had any highlights. No, this is just talking about the durable goods orders here, which we already kind of went over just now. Um, we do have some Fed speakers later in the day today, I believe, if I'm not mistaken. Yesterday, Fed speakers kind of just reiterated comments from the FOMC meeting. Some of them did push back slightly on the rate cut trajectory, signaling that they only see one rate cut this year instead of two, which is something we need to be mindful of. Obviously, of course, if we continue to see supportive economic data and disinflationary trends continue, then we can continue to project that the Fed will cut rates this year, which I believe, looking at the CME Fed Watch tool right now, the probability of interest rates remaining at the current range of 4.25 to 4.50% in May's meeting is an 88.4% chance. So right now the market's pricing in a very high probability that the cuts are gonna, sorry, excuse me, that the rates are gonna remain the same at the next meeting in May, and that they're not gonna cut rates. However, for June, the odds of borrowing costs being lower stand at 65.6%. So possibly looking at a rate cut in June, and then beyond the rest of 2025. Again, that will all really depend on PCE inflation data, PPI, CPI data that we get in the next 2 months, along with labor market figures and just general economic data and strength in the US economy. So we'll continue to monitor that for now. Let's see what else we have here. Okay, so let's dive into this report. So overall today, right, we're still seeing positive fundamentals. We're not seeing any significant sell pressure in the markets right now, which is a good thing. Like I said, the data today, albeit it was not enough to spark significant buying, it was at least enough for us to not see recessionary fears, which is a good thing, right? So far. Okay. And then outside of that, we're still seeing some mounting uncertainties create more demand intraday for safe haven assets. So again, I'm trying to get you guys to see why today, if you were looking to go in and long the markets extremely high, right, with 100x leverage, why that's not really your best bet today, or at least why that hasn't been reflected in price action as of time of recording, right? Because in an hour from now, Trump could come out and be like, oh, freaking no tariffs ever again. And the markets would flip risk on. I'm just saying, so right now in the moment, I'm trying to teach you guys what the fundamentals are currently in the environment that we're operating in. All right. So let's talk about this report and let's talk about the correlation. I want to read thoroughly through the report first, and then we'll get into the correlation. So let's just switch share screen real fast and let's go over and let's make our own highlights. While we thoroughly read through, I believe it's a 11-page report together. So we'll skip around. We won't read every single paragraph. I just want to kind of briefly skim through it so you guys can see how fast. I mean, maybe this will take 15, 20 minutes. And just show you guys kind of what I pay attention to, what highlights I look for. And again, this is an institutional research report. So tap in, right? Let's go over, and I'm not even gonna lie to you guys. It's literally almost as if you're just reading a CYPRX report. Can you guys see this? I'm gonna zoom in with the font here. All right, so starting off at the top, a relatively calm market ripe for more tariff-induced volatility. Bitcoin, and by the way, it is, I'd say, because it's an institutional report, right? They really only focus on, most of these reports only talk about Bitcoin and ETH metrics for the record. So I'm not a Bitcoin maxi by any means, so most of this is on Bitcoin, but still we can look at it in terms of, excuse me, the broad market sentiment that it delivers. Bitcoin sits on a weekly gain of 4%. I'm honestly just going to skim through it as if I'm reading it so we can get through it. I'm going to make highlights as we go. Testing at $88,000 following a slightly dovish FOMC, right? So as I mentioned to you guys just a second ago, I know I said that. If we go back and we look at where the market started to turn around, one of the primary drivers of the recent market optimism and turnaround in risk assets was the dovish leaning tone from Jerome Powell, signaling at, or he didn't signal because he's very strategic with the words that he says, but the markets after the FOMC meeting gravitated more towards possibility of interest rate cuts from the Fed of 2 to 3 later this year. So he hinted at a more dovish tone. Um, Following a slightly leaning dovish FOMC and signs that Trump may be considering a more benign tariff strategy, tariffs remain the primary producer of market moving headlines. So again, boom, there's a highlight right there. Literally tells you right there what you should be paying attention to. Tariff headlines. Those are reactive headlines, and they have been since the beginning of the year, rendering most traders risk averse as we approach a big day of tariff announcements on April 2nd. While markets are relatively calm now, this is shaping up to be a big day for volatility as the markets absorb the tariff announcements, considering our expectation of tariff-induced volatility. We recommend caution and avoid leveraging. Scaredy cats. All right, CME traders remain relatively passive and defensive. I'm highlighting this right there. That is huge, right? I want to ask you guys this question. In a couple of Zoom calls ago, what strategy did I try to teach you guys? Anybody remember?
Wasn't it the buy limits?
Exactly, the buy limit strategy. It's a passive and defensive strategy. We're still bullish on the market. We're not really sitting here trying to guess bottom, so we don't know when the market's going to turn around. So, as a buyer, as a bullish individual in these markets that's still trying to be cautious and understanding that we could still experience some downside momentum, I've been taking a passive and defensive approach. I've told you guys on specific assets that I'm looking to buy and add to my portfolio now. I'm gathering an area of interest at which I don't want to be a buyer above. So take quant, for example, right? Quant, I'm very heavily bullish on. I personally don't want to buy quant above $90, right? $90 is where I'm willing to stop buying quant if price action breaks above. So between roughly around 88 to $90, I would like to buy some quant before it appreciates above that area. And right now it's trading at $77, right? So I'm not buying it now at $77, but I'm putting some buy limits above highs where the market's currently trading at now at the prices that I'm willing to buy it at a discount before it goes higher. And I'm just waiting. At the same time, playing a defensive approach where I also am in the middle of thinking that the market could go lower if conditions worsen. So I'm putting buy limits at $60. I'm putting buy limits at $55 as well. I'm playing both the passive and defensive side. I'm not taking leverage. I'm strategically positioning myself in case the markets turn around from here so I can still get in at discount, but I'm also preserving my capital and not entering in the market right now under the expectation that if conditions worsen, we could go lower, right? So boom, right here, this is a freaking institutional report, literally just backing what I told you guys I'm doing in the markets for my DCA positions like 3 weeks ago. You know what I mean? It's crazy. As selling pressure from the recent market-wide de-risking subsides, Bitcoin continues to stabilize with an 80K within an 80K range. In line with this, Bitcoin ETPs have also seen 7 back-to-back days of net inflows. Although the inflows are moderate, we can highlight that right there. It goes to confirm things that I've been trying to teach you guys that yes, we're seeing some bullish optimism come back to the markets, but what have I told you guys? We're not seeing aggressive what? Aggressive buyers. I know I said that, right? So we are seeing inflows, but they're moderate. And they are stark in contrast to the huge ETP outflows of 76,800 Bitcoin experienced from January 31st to March 13th. So again, we are seeing a slight uptick in optimism. Investors that are most likely more risk on, right, in their portfolio are like, okay, maybe this is the time to dip our toes in and get in. But we still need to be cognizant and careful of the downside risks. The market's relative calmness is expected to persist to April 2nd. Again, that just gives us an insight into dates. The scheduled date for Trump's major reciprocal tariff announcement. So we can mark that on our calendars as retail investors to just be mindful of and pay attention to. If Trump, this is important, right? Because again, how many times have you seen individuals on this space, especially outside of this community, attack this community because we do if-then scenarios, right? They're like, oh, you are always right because you play both sides of the market, right? Duh, because we don't have a crystal ball. Why would you not want to do that? Why would you not want to take a reactive approach? You make a main bias, right? Most most of the time my biases, because I'm a predominant buyer, are bullish, right? So that's usually always my main case scenario. But I'm not a wimp. I can react to the market conditions if they change. You can't marry a bias. So, in the nutshell, you actually have to play if then scenarios to actually be a productive market participant, right? So, look at this. It says if Trump softens his stance, markets could rally. If he remains vague, volatility may hit both long and short positions. If he takes a hard line, then expect a sharp decline similar to the previous tariff related drops is likely. So, literally, in a nutshell, let's highlight this and color coordinate it, right? The first statement is bullish. So, he says if Trump softens his stance, markets could rally. That's bullish. We'll highlight that in green. Yellow is their moderate stance, where he says if he remains vague, volatility may hit both long and short positions. So, that would be sideways movements, right? A wick to the up and downside, right? And then the bearish case will put in red. They say if he takes a hardline approach, then expect a sharp decline, similar to previous tariff related drops is likely. That is literally an institutional if then approach, and it's extremely simple. I'm not even going to lie, that literally sounds exactly like a CYPRX report, right? Know what would happen if current market conditions unfolded. And when they unfold, you're going to be so much better prepared to react to them by adjusting your positions. Maybe it's in DeFi, maybe it's in DCAs, maybe it's in leverage, if you actually know the environment that it's painting, right? So that was really good too. Let's skip on. Let's see what else we got. Okay, so this is just talking about K through 3 holdings, right? So at the end of the day, that's really all we need to read from this report. Nothing too stark, right? Again, just showing you guys that they're talking about the same things. Actually, as a matter of fact, I'd say outside of these metrics and these analytics here, which, we obviously, of course, don't have all these metrics and analytics. I'm gonna probably go find a platform that'll give them to us. I'd have to pay for it, so that way we could gather them. But outside of that, I'd say that all the highlights that we've made on this report thus far sounds exactly like a CyberX report. I mean, almost word for word, right? Probably actually CyberX report goes a little bit more in detail because we talk about things outside of Bitcoin, right? So I just wanted to show you guys that, again, it talks about to highlight remaining relatively passive and defensive. Okay. I know that the vast majority of us here are bullish long term, but we still need to understand short term downside risks remain, especially if these scenarios play out. So in our report, when we talk about our analysis moving forward, we need to be mindful negative implications, escalations and tensions in the Middle East, Russia, Ukraine, any pushback on peace talks, any downbeat economic data that sparks recessionary fears, any uptick in inflation, any hawkish commentary from central bank speakers like Bank of Japan creating more demand for yen, bringing more rate hike scenarios to the table this year. All those factors, right, create a risk off environment. We know right now, according to institutions, both Signum and this research report, I'm just showing you guys two examples, crypto right now is heavily correlated to risk assets. So in the future, like maybe if utility kicks in, like let's say 2 years from now, right? If you're in CyberX in 2027, we might not be talking about crypto's correlation to risk assets because we might be in an environment where crypto has decoupled from risk assets and we see real utility kick in and we're in a freaking massive super cycle on certain assets. Even though they're still being day traded, they're actually being utilized for their utility. And so they might not pull back like the rest of risk assets or crypto that's still correlated to risk, right? We'll get to that when we get there. But again, we just need to understand the current environment. All right. So let's take a step back. Let me stop sharing this screen. Let's go back to the other.
Yeah, I can see it.
Okay, cool. So let's first take a look at these inverse correlations. So when I say inverse correlation, I mean when we see strength in safe haven assets like gold or the Japanese yen or any other safe haven asset, safe haven assets in terms of currencies, you got the Swiss franc, you got the United States dollar, um, so on and so forth, right? When I say inverse correlations, I mean when we see strength in safe haven assets, we tend to see it negatively reflected in the price action of risk assets like stocks and crypto. Okay. And so over here on the right-hand side, we have the total cryptocurrency market, including Bitcoin. And over here on the left-hand side, we have gold. We're also going to take a look at the Japanese yen. I want you guys to pay attention to key dates and key price action. All right. Let me just turn off these indicators real quick so it is less crowded. So we are on the daily time frame. We're going to be looking at the daily time frame for both gold total cryptocurrency market, and the Japanese yen basket. And I want to take your attention back here to December 18th, 2024. Can anybody in this community tell me what happened on December 18th, 2024, and why or what fundamental it was that created this shift and optimism in risk assets, and instead investors reallocated and repositioned themselves, taking profit and risk and reallocating that into safe haven assets like gold? Can anybody tell me?
Jerome Powell speech.
Beautiful, Kev, right? It was when Jerome Powell spoke at the FOMC meeting in December, and he came out more hawkish leaning, pushing back on the rate cut trajectory that was set to take place in 2025. Whereas previous to that, in the rally from November up into December, markets were heavily pricing in 4 interest rate cuts here in this area. Right? And then Jerome Powell came in and dialed all those interest rate cuts back from 4 down to 2, right? And then so risk assets started seeing sell pressure. At the same exact time, on December 18th, we saw gold bottom out at $2,581 per ounce, and we started to see inflows come into gold, right? The second area of interest I want to take your attention to is roughly in between the dates of Friday, 17th of January, to the 28th of January 2025. At the same exact time that crypto was creating a lower high in the market, and then we started to see some sell pressure come in. So this was after President Trump's inauguration, right? This was after and shortly, literally after his inauguration, like days after, he started announcing tariff implications. He started saying, "Oh, all year we got tariffs, baby." Right? Okay. And we can see the impact that it had on risk assets, right? Markets started becoming uncertain. Trump was making all these breaking headlines. People were freaking out. Oh my gosh, tariffs are going to lead to an economic recession. Oh my gosh, tariffs are going to lead to inflation spiraling out of control. We started to see economic projections of a recession increase left and right. We had dwindling economic activity as well, right? And it just, again, all a whole bunch of market uncertainty, fear, and doubt. And as you heard, if you watch the Signum report representative, she mentioned that the sentiment from the beginning of the year was worse than it was in 2022 when FTX collapsed, right? And so we see the negative implication that that had on crypto. We sold off from $3.7 trillion all the way down into 2.8. So the market almost lost $1 trillion in value in just January to February alone. Okay. And then that in terms of gold, look at the dates, right? That is exactly when gold came up to this resistance area here in this area, right? At roughly around $2,700 per ounce. Gold tested it, pulled back slightly, created a higher low. At the same exact time, crypto made a lower high, and gold broke that resistance, retested it, and continued to rally up, right? So you can see the inverse correlation here. Gold strengthening at the same exact time, we're seeing decrease in strength in risk assets like crypto, right? And the dates are all correlated. Everything matches the lines perfectly to the price action. So that puts us at to where we're at currently. If we look at the times, since buyers, I don't want to call them like, because they're not aggressive buyers by any means, but since buyers have recently come in, I personally don't think it's buyers. I honestly think it might just be sellers taking some profit. So we'll see. But regardless, we've seen some more buying activity as of recent, a slight recovery from the March sell-off. Roughly about halfway of March's sell-off, we've recovered in the total cryptocurrency market cap. And we can see that that's been correlated with some profit taking on gold, right? Gold has slightly pulled back from its all-time high at roughly about $3,060 per ounce, give or take. Now currently trading at $3,015 per ounce. We've seen a slight pullback on gold, and we've seen slight buy pressure on crypto, right? This is even more apparent in another safe haven asset like the Japanese yen. So let's go take a look at the yen correlation, right? And I'm going to blow your mind here. I'm going to invert the charts, and you're going to see that the price action literally looks identical. Okay. So if we come over here, we have the yen on the left, we have crypto on the right, same dates. Let's just go through them real quick. In between December, 17th, 18th was the Fed FOMC meeting, all the way up until roughly about January 1st. That circle you can see was the same exact time profit taking took place in total cryptocurrency market, and strength came into the yen. right? The second date, where the yen created a higher high, higher low formation, was the same exact date window between Monday, January 20th, give or take, to the end of January, rolling into February. So we created a higher high, higher low formation, right? Same thing with cryptos, the same exact date we created a lower low. Yen continued to strengthen, crypto continued to weaken, and then more recently, when we saw some profit taking unfold in the yen in the window between March the 1st through give or take March the 10th, is the exact same time in crypto when we started to see inflows, right? So check this out. I'm going to invert the charts. So crypto is going to look bullish, but this is still the downtrend as of recent. Look at how freaking correlated this is right now. So let's take a price action tool and let's go. Here's the December window where we first started seeing sell pressure and risk assets after Jerome Powell's FOMC meeting. Safe haven assets created a high, higher low, higher high formation and rallied all the way up until recent times in March. Then in March, we started to see some profit taking in safe haven assets such as the yen, which have resulted itself in some slight bullish activity in crypto. If we literally copy this, so I'm going to clone it and I'm going to paste it over here, it is the same exact price action. We see a bullish move in crypto, a pullback, a higher low that has led to a rally. And I'm going to clone this from the exact same date, copy, paste it over here to crypto. And we can see as we've seen outflows of safe havens, we've seen a bullish uptick in crypto. Now, invert this back to normal. It is the exact same inverse correlation. As above, so below, right? When we're seeing outflows of risk assets, we've seen inflows into safe haven. Crypto made a lower high, yen made a higher low, rallied, crypto dumped, and now as of recent, we've seen a slight uptick in bullish price action in crypto. And this is why I'm saying that I think that this rally in crypto that we've seen is only because of profit taking in safe haven assets, because the environment has become a little bit, not necessarily more clear, but we've seen more positive developments. Excuse me. We've seen headlines surrounding a possibility of a Russia-Ukraine ceasefire. We saw Trump slightly scale back the tariff implications, ease that uncertainty in the market. And then we've also seen some positive economic data on the US front, easing those recessionary fears. But we've not really seen any major confirmation yet, right? We haven't really seen any solidification that the current market uncertainty that has been driving demand for safe haven assets is fading, right? So that's why I'm still cautious. That is why I'm trying to show you guys these correlations and show you guys physically all these people that are expecting the market to just freaking pump right now, right? And just do some shit like this. What would we need to see more of in safe haven assets? We would need to see more outflow, right? We would need to see more outflow. And again, going back to the inverse correlation, if we want to see this in crypto right now with the current environment, we need to see this, and we're not seeing that yet, right? So, in order for us to accurately project these things, let's go into our economic overview, right? So, let's always cover the bull case first because I'm a bullish market participant, I'm a bullish investor, and I'm a bullish day trader, right? I look for long positions most of the time.